Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Lamar Advertising Company annual report. Lamar Advertising offers a wide range of outdoor advertising services that cater to both local businesses and national brands. The company provides various formats such as billboard, interstate logo, transit, and airport advertising, allowing advertisers to reach broad audiences across North America. In addition to its traditional out-of-home inventory, Lamar also boasts the largest network of digital billboards in the United States with over 54,000 displays. This cutting-edge technology enables advertisers to effectively engage their target audience through dynamic and eye-catching visuals. The stock price of Lamar Advertising Co. has seen an increase of approximately 8.96% in the past year, driven by several key news events and strong financial performances. One major contributor was the company's impressive fourth quarter and full year 2025 financial results, which exceeded analyst estimates across various metrics. Lamar reported net revenues of $595.9 million for Q4 2025, surpassing expectations, with a significant increase in adjusted funds from operations, AFFO per share. The company also saw a substantial turnaround in net income, jumping 63.4% to $593.1 million. Additionally, Lamar's adjusted EBITDA grew by 3.7% to $288.9 million. The company's positive outlook for fiscal year 2026, projecting diluted AFFO per share between $8.50 and $8.70, has also contributed to the stock price increase. This guidance anticipates continued sales momentum, growth in digital and programmatic advertising, and a boost from political advertising revenue in the upcoming midterm elections. Furthermore, Lamar's strategic focus on converting traditional billboards to digital displays is driving growth, with plans to add over 320 more digital displays in 2026. The company has also demonstrated strong growth in programmatic advertising, with revenue up approximately 19%. Additionally, Lamar remains active in acquisitions, targeting around $200 million in 2026. Analysts are bullish on Lamar due to its dominant market position in the out-of-home advertising sector and its conservative balance sheet with ample liquidity. The company's real estate investment trust, REIT, structure also supports a strong dividend yield. Overall, these factors have contributed to the increase in Lamar Advertising Co.'s stock price over the past year. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline in a company can be identified through various factors. On the positive side, an increase in billboard net revenues and logo net revenues has been observed, contributing to revenue growth. The expansion of digital billboards is also a significant factor, as it provides new opportunities for advertising and increases revenue. Additionally, acquisition-adjusted increases in both billboard and logo net revenues have contributed to revenue growth. Furthermore, the occupancy of existing advertising displays has increased, resulting in higher revenue. A raise in advertising rates has also been observed, which further contributes to revenue growth. On the other hand, a decrease in transit net revenues has led to a decline in revenue. Seasonality is another factor that affects revenue, with the strongest financial performance seen during summer and fall, and the weakest during the first quarter. Competition from other forms of out-of-home advertising and media also poses a challenge to revenue growth. Overall, these factors highlight the importance of understanding the drivers of revenue growth or decline in order to make informed business decisions. Net income and profit margins. A year of growth and improvement, the net income of the company experienced a significant increase, rising by 63.4% from $362.9 million in 2024 to $593.1 million in 2025. This substantial growth can be attributed to various factors, including a decrease in interest expense and an increase in operating income due to lower depreciation and amortization expenses. The profit margins also saw a notable improvement, with the net income margin increasing from 16.4% in 2024 to 26.2% in 2025. The operating income margin rose by 10.1 percentage points, reaching 34.2% in 2025. Additionally, the adjusted EBITDA margin remains stable at 2.4%. The reasons behind these improvements are multifaceted. A decrease in interest expense and a gain from the sale of Vistar Media contributed to the increase in net income. Furthermore, the company's operating income benefited from lower depreciation and amortization expenses, as well as a gain on disposition of assets and investments. Overall, the data suggests that the company experienced a year of growth and improvement in terms of net income and profit margins. The factors contributing to this growth are diverse and indicate a positive trend for the company's financial performance. The company's financial performance is a notable aspect of its overall health. According to the provided information, the company has been generating positive operating cash flow in recent years. Specifically, for the year 2025, the operating cash flow was reported as $864,049 on page 61 and $825,009 on page 111. These figures indicate that the company is successfully managing its day-to-day operations to produce a surplus of cash. This is a positive sign for investors and stakeholders, as it suggests that the company has sufficient liquidity to meet its financial obligations and invest in growth opportunities. The consistency of this trend across different sources further reinforces the notion that the company's operating cash flow is indeed positive. The company's debt level has undergone significant changes over the past year. The total debt outstanding at December 31, 2025 was $948.3 million, which is an increase from previous years. Specifically, the long-term debt increased by $207,805,000 from 2024 to 2025, and the company's working capital deficit decreased by $18.9 million. The interest expenses have also shown some changes, but not as significant as the debt level. The interest expense decreased slightly due to a decrease in deferred financing costs, and it has been reported that the company replaced the London Interbank offered rate with term SOFR as the successor rate. However, there are conflicting reports on the interest expenses, with some pages indicating an increase and others showing a decrease. Overall, while the debt level has increased significantly due to new loans and notes, the interest expenses have decreased slightly. The performance of various segments and regions within a company has been analyzed. Domestic operations have performed well, although specific numbers are not mentioned. In foreign countries, revenue increased in 2025 compared to 2024, but long-lived assets decreased. In contrast, revenue was lower in 2023 than in the following 2 years. The billboard segment saw an increase in net revenues in 2025, but also experienced a rise in advertising expenses. However, segmented adjusted EBITDA improved in 2025 compared to 2023 and 2024. On the other hand, the other segment reported decreased net revenues in 2025, along with lower advertising expenses. Consequently, segmented adjusted EBITDA declined in 2025 relative to 2023 and 2024. Overall, while some segments showed improvement, others experienced decline. Management's outlook and strategy. The company's management is optimistic about its future prospects, despite acknowledging various risks and uncertainties that may impact financial performance. They plan to focus on internal growth through targeted marketing efforts, upgrading existing displays, and expanding their digital billboard inventory. A key aspect of the company's strategy is reinvesting in existing assets and expanding its outdoor advertising display portfolio through new construction. This will not only increase revenue, but also provide a strong market share in small to mid-size markets. Management believes that outdoor advertising is cost-efficient compared to other media, making it an attractive option. In terms of capital allocation, management plans to invest in opportunities that meet return on investment criteria, including strategic acquisitions and expanding its digital billboard inventory. This approach will enable the company to grow its business while minimizing risks. Overall, management's strategy is centered around leveraging internal growth, investing in existing assets, and expanding its outdoor advertising capabilities to drive revenue and market share. The company has demonstrated its commitment to returning value to shareholders through both dividend payments and share buybacks. In terms of dividends, the company has consistently met the requirement of distributing at least 90% of its REIT taxable income to common stockholders. This is evident from multiple pages in the report, including page 5, where it is stated that the company distributed an amount equal to at least 90% of its REIT taxable income. Furthermore, the company has declared and paid significant amounts in dividends, with $655.9 million being distributed in 2025, resulting in a dividend per share of $6.45. This shows that the company is committed to providing returns to its shareholders through regular dividend payments. In addition to dividend payments, the company has also engaged in share buybacks. Under the stock repurchase program, the company has authorized the repurchase of up to $400,000 of Class A common stock. In 2025, the company repurchased 1,388,091 shares for a total purchase price of $150,000. This demonstrates that the company is also committed to reducing its outstanding share count and increasing earnings per share through strategic share buybacks. Overall, the company's actions demonstrate a strong commitment to returning value to shareholders through both dividend payments and share buybacks. While reviewing the financial report, one notable concern arises regarding the company's operations. Although there are no explicit worries about inventory buildup or supply chain disruption, potential issues do exist in other areas. Specifically, the report highlights possible restrictions on digital billboards due to aesthetic and safety concerns. This could impact future deployments and existing inventory, potentially affecting the company's overall performance. That concludes the financial summary for Lamar Advertising Company. Feel free to comment below, and I will be happy to answer them when possible.